This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we are very pleased to welcome on Brian Daly with Groundfloor Finance. Definitely going to be some interesting things to unpack here today. I'm really excited for the conversation. As I don't think anyone can introduce themselves as well as the person being interviewed. So I'll let you kind of give a brief introduction of yourself, kind of how, what got you to the place that you're in right now. And then we'll jump into the topic of hand of smaller or fractionalized investing in real estate debt. So Brian, thanks very much for being on with us today.
Well, I'm happy to be here. And that story begins when I was about 14 or 15 years old. At the time, my dad sent me to the library to learn about investing. And specifically, he said, go learn what a mutual fund is. If you find one and that you want to invest in, tell me about it, pitch me. And, your summer earnings, whatever you put in for your summer earnings, I'll double it. I was very quickly motivated, became very interested in investing, learned about dollar cost averaging at a very early age. And I've always been fascinated with investing. And if you fast forward many years later, I won't say how many years later, but if you fast forward many years later in 2012, Congress passed the Jobs Act. So fast forward to 2012, Congress passed the Jobs Act, and important parts of the Jobs Act were intended to liberalize capital markets. And this fascinated me for a lot of reasons. I had the good fortune of meeting my co-founder, Nick Bargava, who actually worked on that legislation. He lobbied Congress and worked with the interest groups and the legislators to help formulate and include Title III, which was the crowdfunding, equity crowdfunding part of the legislation. We were introduced because of our interest in that, his expertise in it. And we started talking about different ideas for how a mass market investment product could be created using that legislation. And that was the genesis of Groundfloor. It was, long way since then, obviously, but that's how we got our start.
Great. Yeah. I got my start of my career in finance right in the, beginning of all of that, back in late 2011, 2012. So it's been interesting to kind of, I don't obviously have a basis of knowledge of saying, hey, here's what it was like beforehand in dealing with private equities and everything else, which was such a walled garden beforehand, which again, to the democratization of, private financial markets has been really interesting to watch. And again, to the veins of increased offerings for like your Reg A's and then different Reg D's with regard to accredited investors, syndications, commercial real estate, all the different, forms and flavors of what kind of came out of that. It's been really interesting to watch. Now, one of the more interesting segments, I think it's, easy enough to say, okay, it's easy to see these people that are trying to raise, millions of dollars to invest in an apartment building or commercial real estate or XYZ venture are saying, okay, well, you're still, again, walled garden, $250,000 of annual income, $1 million of assets, excluding your personal house, things like that. That makes sense. But the smaller dollar figure stuff I really find interesting. And that's, again, what Groundfloor kind of focuses on is that. And again, I know you said, and I'm sure you're going to get into why you don't like the crowdfunding side of things, but with fractionalized investing, and when we had our pre-conversation, I really enjoyed, the thought process you had about what exactly it is you do. And I'm a big fan of real estate. The fact that they call it an alternative asset, I find disingenuous because, the Romans weren't buying stocks and ETFs and Microsoft. They were conquering real estate. They were going out and acquiring land. So there, there's few things as, as more traditional than that. So let's kind of get into, you identify this need on, this is the segment you want to focus on. So what does that kind of start out as?
Well, the thing about alternatives, there are a lot of problems with alternatives from the standpoint of a retail investor, right? If you think about public market investing, it's very regulated. We have generally accepted accounting principles. We have, a disclosure regime, K's and Q's, for example, for earnings. There's, a time-honored process for publishing a prospectus about a company that's coming public. Even in the world of ETFs and mutual funds, right? Everything is regulated in a way that makes it more or less a level playing field. Now, in general, you're buying secondary shares and you're sitting at a poker table with people who can game you. And we saw that in the meme stock phenomenon with short sellers and, the Redditors were battling. And so that can be, the world of trading is, to my way of thinking, very different from the world of saving and investing. And, there's a big distinction to be made in public markets around that. One of the problems in alternatives is that there's no such disclosure regime, right? Whether you're investing in a commercial office building or a startup, right? The disclosures are governed by the rules of fraud and misrepresentation.
Sure.
There's no standardized, or there hasn't been a standardized, I think I read the other day, $2 trillion is invested via Regulation D, the 506C or 506B, exemption to securities law, $2 trillion. And it's basically invested in what is essentially the Wild West. I mean, it's unregulated, it's unmanageable from the standpoint of a retail investor who's just trying to figure out how to get the benefit of this and allocate and not lose. It's at once very threatening, right, because of that, and difficult to navigate, even if you can access it. And at the same time, it also feels a little esoteric, right, and unfamiliar. So when we started looking for the product, right, that we were going to finance, what is this product going to be made of? We listened to investors talk about what some of these concerns were. And one of the big concerns is we want something that we understand. Well, what's more understandable than single family residential real estate, right? At any given point, 62, 63, 64% of Americans own a house. So, and over time, many, many more, a much higher proportion of Americans will. And so we figured it was very familiar. And of course, real estate in general is tangible. So you kind of know it's not a trading card or an NFT or something like that. It's it's tangible. People know what it is. So the familiarity of it and the tangibility of it drove us there. On the regulatory side, we committed ourselves to the disclosure regime and the regulatory oversight that came with Regulation A. That's akin to what public companies have to do because, again, we felt that would be not only healthier for investors, but it would be healthier for our platform. And I think we are a better platform because we have submitted to that regulatory oversight over time, and because we file audited statements annually and have for 7 or 8 years now, and because we're subject to regulatory oversight, we have to follow rules for disclosure. These are the things that mass market investors expect. And then they expect one other thing that we got right from the very early days of Groundfloor, which is if you go back to those days, I mentioned that I started off investing in mutual funds. One of the things I thought was pretty cool is if I had $100 to invest, I could invest it in 3 different funds and I could reinvest the dividends, right? Dividend reinvestment program has been around a long time in public market investing. And I could buy a fraction of a share, no matter how expensive Fidelity, Magellan, or 20th Century Growth Fund was at the time, or if it was an international fund, I could invest fractionally so that I could control my exposure and my weighting in my portfolio. Now you see that in public stock investing, like on Amazon, right? If you go to Robinhood and buy Amazon, you don't have to afford a full Amazon share, right? You can buy a fraction of a share or a fraction of Google or a fraction of Tesla, and you can build up your own portfolio. Well, that never really existed in alternatives either. And so we fractionalized our offering down to $10. Actually, originally it was $100. In 2014, we fractionalized it down to $10. And this year, with our Groundfloor 3.0 release that's launching here next week, actually, it'll probably be out by the time it'll probably be launched by the time the show airs. We're fractionalizing down to the $1 level, which means you can essentially index and diversify to your heart's content, no matter how much money you have. And that's purposeful. So those 3 things, those 3 issues and alternatives we set out to solve. And I think one of the reasons we've been successful $300 million under assets under management, $1 billion transacted on the platform by retail investors since we started. I think one reason we've been successful is we've gotten those three things right.
Sure. So let's just kind of again start a little bit from the beginning and then get into the actual, thesis of how this kind of breaks down into real estate because, and I've said this a lot and it's cheesy, but it holds true. Real estate is many things, but cheap it's not. It's a lot of different things to a lot of different people, and most of the time can be very beneficial. But again, it is a high dollar priced item. You're
Oh
talking
yeah,
about buying an asset that's the same as Burke A. It's talking about these large dollar figure items that, okay, great, it looks awesome on paper. You can look at a track record, and especially over the last decade, up and to the right is what it looks like. But again, figuring out how that works on a smaller level. But to the point, a lot of our audience, are probably tangentially familiar, at least with, different types of Jobs Act requirements, Reg D versus Reg A. And what people may not necessarily be aware of, and a lot of people just kind of focus on, hey, do I have to be accredited or not accredited to do this? Maybe they're not necessarily as familiar, like you said, that there's a lot of stripping away of the reporting requirements and kind of those safety nets and catches that traditional security markets enjoy that aren't necessarily offered to the alternative space. So maybe just again on a very high level,
yeah.
maybe talk about what kind of things that people that operate under the again crowdfunding section of Reg A, what they're required to do versus someone that is doing a let's say a Reg D, closed offering that's accredited investor only. Just again high level so people kind of understand again
Sure.
maybe some of the perceived benefit of doing something that has a little bit more oversight.
Well, so for example, if you are, conducting a Regulation D offering, you're going to disclose whatever you think investors need to see in order to make the sale of the investment, or in order to be successful in offering the investment. And if I'm out raising venture capital from a VC firm or angel investors, the mileage will vary. Some angel investors want, a model, that maybe at the early stages of your startup you don't have. VC firms certainly want to get into your unit economics analysis and assess very technical underpinnings of your business that are, the domain of an expert investor, a professional investor who's going to invest a significant quantum of capital and establish a large ownership position in that, right? That style of investing and that burden is largely inappropriate for the overwhelming majority of individual retail investors. The concentration, the quantum of capital, the expertise required is, to be fair, beyond even somebody who's been investing since age 14 or 15. I worry about it, getting into the weeds of it just from a time management perspective, if nothing else. And so what I like about the disclosure regime, that Reg A, by the way, Reg A is not new. Reg A has been around since the 33 Act. That's 1933. It's been modernized and it's been expanded. And what it offers is a standard of disclosure where risk factors must be disclosed. Relevant factors have to be, discussed within an offering circular. A lot of data about the investments, the underlying investments, how they work, what investors can expect, what risks they should analyze. And it's not just because the issuer says so. The commission reviews those offering circulars and they make sure that all of the requirements within the rules have been met, and they ask questions about inconsistencies. So, maybe an eagle-eyed investor would catch some of that stuff, but professional regulators, who are lawyers by and large, are going to catch that. And we experienced that. They asked lots of questions about how we were disclosing, and is this consistent, and is it consistent with this rule, and does it meet the standard of this rule? And once you've filed the offering circular, and by the way, the SEC doesn't approve anything. They're not in the approval business. They qualify it. It means you have met the standard for disclosure that is set forth by the rules. And we've done that numerous times with numerous offerings. But then after that, there's an ongoing requirement If you're a private investor, you know what it's like. If you put money into a company or into a real estate project and then you never hear from the company again, well, that cannot happen with a publicly regulated offering, because if you won't be allowed to offer securities anymore, right? You're violating the rule around ongoing disclosure. And not only that, a Reg A offering has to be refreshed and requalified every 3 years. So there are standards and guidelines and practices that are enforced by regulators on pain of, rescission, right? Unwinding the offering, having to give the capital back, on pain of shutting down your ability to conduct future offerings. And so companies like us, two things happen. One, we spend a lot of money and time making sure that we are compliant. And then in the process, we feel an accountability to make the investment better. And by better, I mean better disclosed, better managed, better communicated, both at the time of the offering and ongoing. And I think that's a material difference to the scalability of these investments to a broader audience beyond the top 4% of US households and institutions who have the capital to go concentrate and and the time and expertise to go focus. I actually think for accredited investors, these Reg A offerings are much better because of these standards of disclosure that they get. But even if they never read a word of it, knowing that it's there disciplined the issuer to go do the work to make it efficiently consistent, homogeneous, relatable, understandable. And this is what we did. It took a long time, by the way. It took 5 years and a couple $1 million, to get to the stage where we were able to offer these securities to accredited investors and non-accredited investors nationwide. But now we've done that work, and we're a reliable issuer and a trusted platform for tens of thousands of investors as a result.
Yeah, no, those are really great points to make. And that's something that I run across a lot with people getting into the space of private securities a lot, is that, they just don't realize that saying, hey, I see a prospectus. Okay, great. This all looks awesome. And, me being a glutton for punishment, I enjoy reading those. But the average person, it's basically NyQuil on paper format. It's going to put you to sleep because there's a lot of stuff in there. Then, unless, again, you're either someone like me that just enjoys it, or you're someone that is, maybe also a deal sponsor or putting these together, a lot of it doesn't necessarily always kind of make sense. And especially with some stuff where there is less reporting requirements that are out there, well, again, like you said, it forces people to do work and reevaluate stuff. And I think that, again, that can be a really big benefit. Again, like you said, very much so to people that have a lot of capital, but also specifically towards the retail investor, because while I would love to say that everyone needs to be protected equally, the people that don't qualify as accredited investors have a lot more to lose from losing much less than people that are significantly higher net worth of losing, a multiple of that. So having some of those safeguards built in and having kind of a mechanism that will direct people to, again, continually do work and continually reevaluate this, I think is really important. And unless you have something else to add to that point, let's kind of now start looking at structurally how this works. You mentioned that what you're looking at is single family home base. So a lot of times private securities, syndications, anything in the spectrum of the Jobs Act or private securities is mainly focused on commercial development or industrial real estate. There's not a whole lot. Well, I should say there are some very big players in this space, but a lot of them either are focusing on the equitable ownership of stuff, but very few people, at least in my summation and what I've experienced, focus on debt in the single family space. So let's kind of get into the nuts and bolts of exactly kind of what you started putting together, and again, how this actually works functionally from the fractionalized investing in single family real estate.
So I would love to claim that we were just so smart that we figured out that this would be the right product, to scale. That's not actually the story. Necessity is the mother of invention. In our case, we needed a product that had a few key attributes in order to gain some traction in the early days. Remember, when we launched 2013, nobody ever really heard of any of this. Right? It wasn't in the public consciousness, and so it sounded too good to be true. It needed to be formatted in a way that you could win some early adopters in the early going. And I'm really glad that we discovered this corner of real estate investing that we did. The requirements that we realized we needed and we found with these sort of short-term business purpose real estate investment loans, uh, we needed something that was short-term, which ideally like a year or less, before you get your capital back. Because a lot of times in these alternative investments, you put your capital in a fund or in a real estate project or a collection of trading cards or art or whatever. You never know when you're going to get your money back, right? If it's not an income producing asset, you may not even get any payments along the way, right? You're just waiting for it to sell or something,
Mhm.
it's unclear.
Windfall
So,
investing.
yes, well, not with this investing because the data shows, if you're lending money to somebody, they owe you that money back with interest at a certain time period. And if they don't pay it back, there are consequences. That's not true with equity investing, right? Equity investing, we say, hey, if you invest in Groundfloor as a startup, which by the way, 7,000 of our customers have invested in Groundfloor's equity itself and own 30% of the company. And I field questions from investors who put money into Groundfloor as an equity investment all the time. Well, when are we going to get liquid? Well, the nature of investing in a startup or most alternatives, you don't know. And as an equity investor, you're waiting for the ability to trade it or on a secondary market, or you're waiting for a sale or something. Uh, well, not true with our loans, right? When we loan money to a real estate investor who's going to fix and flip a house or build a new house, or those are the two main use cases, you know, they owe the money back on a certain time period. Sometimes it's a 12-month loan, sometimes it's an 18-month loan, but they owe the money back. And on balance, on average, our investments have returned capital within 10 to 12 months, which is really fast. The second thing we knew we needed was the ability to show a high yield, right? I mean, in order to induce people to sort of show up and try this new thing, it needed to be worth it, right? And so at the time, we thought 8, 9, 10% would be worth it. Now interest rates are higher. So now we write loans that are higher rates, 12, 13, 14%, because we had to raise rates along with the prevailing market. But we needed something that was high yield enough. And thirdly, we needed something that allowed us to make money as a capital provider from the recipient of the capital without charging investors any fees. Because one of our insights with alternatives and a lot of other fund structures in particular is a lot of the money that investors would otherwise make ends up going to fees. Well, that's not true with our platform because we don't charge any fees. We're zero fee because we picked a space where we can return capital quickly, generate a high yield for the investor, and not charge any fees off that yield. It's
Great.
pretty incredible, right? I mean,
Yeah.
and so that's what led us down this path to sort of making these loans. We originate loans to real estate investors, and then we turn around and we fractionalize them we use our own capital to fund the loan, and then we use our platform to fractionalize it to thousands of investors who
Great.
participate, $100 at a time, $200 at a time, typically.
Yeah. So again, just to kind of again, I love getting into the the high level of this, but just so make sure that we're clear on the same page. Essentially, the investment product is investing into debt, secured by single family real estate, where you have a fractionalized ownership of a particular loan tied to a singular piece of real estate. Recorded
Correct.
mortgage. I'm assuming these are all first position, correct?
Yes. Mm-hmm.
Yeah, so first position loans secured by single family real estate. And then in general, your company goes out, funds the loan, and then on the back end, you bifurcate it to all the investors. So they come in, they plug in, you reach a funding goal, that closes, on to the next one, on to the next one. Correct?
And at any given time, we have 80 to 100 loans all over the country that are funding, right? That you
Mhm.
can participate in and allocate into. And of course, we have tools to help you pick and choose and filter so you're not, individually going loan by loan. But if you want to, you can choose to over allocate into it. It's your portfolio. You get to decide. And we think that's another really important point. But it's a great product. I don't think these yields with this short of a hold period and this ability to fractionalize is available anywhere else in the investing universe, frankly.
Yeah,
Certainly
well,
not
especially, yeah, I
so.
would say especially to the point of debt. I think there's things again. no two things are exactly alike in investing or life for that matter, but I think there's a lot more, analogies to be drawn in the acquisition ownership side of things. But
Sure.
really, something especially for, doing IRA work and alternative assets and retirement plan work for so long. Debt's a really popular instrument from people for a myriad of reasons, especially in real estate. When you can remove yourself from, active ownership, you don't have to deal with tenants, termites, and toilets. There's some benefits to that for whether you're a flesh and blood retail investor, an IRA, an entity. There's inherent niceties that come along with just being on the paper side of things.
Well, it's interesting because
Yeah.
when people think about real estate investing, there are a lot of ways to invest in real estate, right? The world doesn't lack for a way to invest in real estate, right? I can buy a REIT of office buildings. I can buy, I can go out and if I have enough money, I can go out and buy a rental property, right? And own a rental property and have a loan on it and get the tax benefits from that. That qualifies. There are fractionalized platforms where I can own a slice of a rental property, right?
Mhm.
What there isn't out there, and there wasn't until Groundfloor showed up, is the ability to own a part of the debt. Now, of course, we've started to expand because of this market position we have. We've started to expand into equity as well. So now you can buy, equity in a house flip or in a new construction project. And we're experimenting with all kinds of products now that we're 10 years old and have a track record and have all these customers. But in the early days, I think, and still our core product is this debt product that I think has uncommon benefits that are very difficult to match. I mean, we've delivered over 10%, 10% returns to investors historically, and that includes during a long time when rates were a lot lower. You would be challenged to make that on a rental property, right? Uh, House price appreciation should be about 4 to 6% a year historically. It may regress to that mean or lower. It would be difficult to earn rent that is in excess of, that's at a cap rate much higher than that, 2, 3, 4% maybe
Mhm.
on a yield basis. And so when you add up, wait a minute, I'm going to go buy a rental property or I'm going to participate fractionally in a rental property. Why would you do that? Aside from I get to be an owner, right, vibe of it, it doesn't pay as well as being the debt provider. The,
Well,
the
yeah,
debt guy, the
absolutely.
credit guys are always the smartest guys in the room in every market. Just watch out.
Yeah, and the equity stuff, I mean, especially from the perspective of, and I just kind of coin it windfall investing. Um, it's market rents are going to be at a certain pace, and then you're relying on an appreciable gain of the underlying asset as opposed to some type of baked in rate of return, which is, again, one reason I personally like notes is that you get to adjust in a lot more real time with the particular markets, the ability to kind of have a knowledge basis of when your windfall is going to be, when that waterfall moment is
Yep.
going to happen, as opposed to leases where, let's say that in turn there's a market correction. Now the loan maybe is underwater, something happens. Well, those rents or the properties underwater. Now, what do you do with rents? Do they go down? Well, again, the perspective of having a much bigger, kind of lottery ticket, definitely there with the equity side of things, but not so much with the debt. And again, I like that for a lot of reasons. And two, if something were to hit the fan, if you're an equitable owner, an equity side of things, well, then the property might get foreclosed. What happens if
Right.
you can't make those payments, as opposed to the debt when they don't make the payments, then you get a piece of real estate. So if something bad happens, you still have something good
And,
happening
and we do,
to an
we
extent.
do, we do end up foreclosing on about 1% of the properties that we finance.
Mhm.
And when we foreclose, sometimes we don't recover enough money to repay the loan, but that's more than offset by all of the money you make on the plus side in a debt portfolio, which is again why we fractionalized it, right? So that
Yeah.
you don't have all your eggs in one basket. I think the other problem with equity investing that people aren't necessarily thinking of is you don't know how long your capital is going to be locked up. You don't know what the ultimate exit price is going to be. You don't know what's going to happen along the way, and you don't necessarily have any recourse along the way.
Hmm.
If we hit into a really big recession and, you know, people can't pay their rent or, there are vacancies, right, run amok, and your property is vacant, there went your income, which your income is a substantial part of what you're hoping to get out of the investment in the first place. That can go away in no time.
Yeah.
And so I think, you know, uh, it's been possible to invest in notes before. The problem was you had to participate in a syndication or in a pool of notes, which has its own problems around concentration and control. And what's unique about our platform is you're not being required to participate in a fund. There's no fund manager who's gatekeeping when you get your money back. You get your money back as each loan repays. And then you can reinvest it or withdraw it or do whatever you want.
Yep.
And you are deciding what risk you want to take when. That's very unusual to have that ability as a retail investor. And again, this year we're taking it down to a $1 minimum. So, even if you only had $100 to invest, you get 100 loans in your portfolio, which is tremendous level of diversification on the order of what hedge funds would want.
Sure. So, two things that I want to kind of cover towards the end of this is one, a big thing that is inherent with any type of alternative investment is, a standard of liquidity. These things inherently, when you do them, are going to be much less liquid than, something on a securities market. If you have a
Oh, yeah.
share of Microsoft, there are market makers all day and twice on Sunday that are making markets for this stuff. So,
For sure.
again, everything being what it may, there's going to be downsides to everything. But I guess one of the kind of things that an investor on this type of platform, and again, it's well understood for the people that are interested in the larger syndications, Reg D, accredited investor offerings, but from the where this kind of bridges that gap from there to the open securities market, I think it's important for people to understand is that these, and correct me if I'm wrong from what you're saying, is that you're invested into a particular loan, and again, the averages be what they may of when they repay, that's kind of your waterfall moment of when it repays and
Yep.
the loan goes back out. But in the interim, how liquid or illiquid is the investment? Is there a buyback clause, kind of like with larger Reg D stuff, or what does it look like from the investor perspective
We
when they allocate funds to this?
so we have always thought that there may be need for a secondary market, and of course, intellectually, we're curious about a secondary market, right? I mean, any platform in this space, that's an interesting problem to solve as an entrepreneur. But we keep waiting for customers, to demand it, and because the loans are so short term, we really haven't seen a lot of demand for it. And the truth is, if you compare investing in ground floor to a REIT or an E-REIT, right? An E-REIT might pay you a 6% or 8% dividend per year, call it 2% a quarter, best case. If you are diversified on ground floor over time, you're going to see 1/10 of your portfolio come back to you every month. So in a world where you see literally not 10% per year, 10% per month of your capital is flowing back to you on the platform, that is a very common experience. Uh, the need for tradability or short-term liquidity isn't so great. Now, there are cases where people might have an emergency where they need to liquidate their portfolio, and we provide for that, but there's no big market for it because the product is so short-term. We've speculated that if we got into longer-term products at scale, that would be the time when secondary market infrastructure would make sense. Because what people really ignore is that the transaction costs in secondary markets that are thinly traded are extremely high.
Yeah.
Um, you know, you brought up Microsoft. Well, that's very broadly traded, right? There's a very large order book, and in fact, multitudes of order books, all over the world for that particular asset. That's not really true in most alternatives, right? There's
Mhm.
not a big order book. But I think those are interesting problems to be solved over the long term, especially as duration moves out.
Yeah, and especially like looking at it, like you said, if you average it, and I'm assuming when people come in to do this type of investment, you can see origination dates, so you can kind of peg, insofar as you're saying, okay, this one
Yeah.
originated yesterday, okay, the likelihood of it running 12, 18 months is probably better than something that might still have some space that's originated in 7 months ago. Now, from that perspective, what does it kind of look like if there is, well, let's back up a little bit. So, loans are great when they run their full course. You get
Sure.
18% on your money over 100 grand. That's great. But if they repay early, what is some kind of safeguards to investors that are built in to make sure that, someone doesn't come to you one day, buy a house, flip it, and then you miss out on all the interest and you just kind of have to eat the transactional cost of that money being tied up. What are some things that are kind of
Yeah,
endemic to this?
our investors don't have to care about that. And that's one of the great virtues of fractionalization, especially hyperfractionalization. Because if one loan repays in 1 month, there's always another one in a similar place with similar attributes and similar characteristics ready to take its place. And we built automated tools that allow you just to roll that money right into the next one, or to stop that, right? So we, like in our Groundfloor 3.0 app, the mobile app that's launching next week, you can set a cash target that says, you know what, don't stop reinvesting until I get $1,000 because I want to withdraw $1,000 or $10,000. And the software will do that for you. But then once you hit that number, it'll start reinvesting again, right? And so software can solve a lot of these problems. And what's interesting to me as an analog is the idea of what happened with ETFs, right? ETFs made it, ETFs, depending on what you're invested in, are always rebalancing, right? They're always rebalancing depending on whether they're market cap weighted or issue weighted, right? They're always rebalancing. There are always new companies being added and dropped because, maybe it tracks a certain index or a certain type of style of investing. And the retail investors don't have to think about that at all, right? They just know they're in this ETF. It's a theme. They're invested in it. If they're in an ESG theme and some company is no longer regarded as an ESG investment, it's quietly dropped. The retail investors don't have to do a damn thing. And that's where alternatives need to get to. In order to really scale, alternatives need to get to the same level that public markets approach through fractionalization and structures that allow people to sit back and know what their money's doing and have control over it. I think it's ridiculous to think that we would turn it over to a fund manager who gets paid 1, 2, 3% to manage your money for you, right? That's ridiculous and unnecessary.
No, absolutely.
In today's world, right? Like you can be your own fund manager. We don't pay. I mean, this is what happened to mutual funds and active investing. No mutual fund manager ever beats the index that they're trying to beat for very long. They might beat it 1 year, but then they're going to fail over the ensuing periods and regress to the mean or worse. Same thing in alternatives. We need these same thing in alternatives, these same benefits for retail investors, and that's what we've been building, right? That's why we're building Groundfloor 3.0, because it's a way of indexing into alternatives in a category that people know that's in a low volatility investment, right? Which is first lien residential real estate debt, right? That I think is starting to prove itself as an asset that can come of age in the same way that ETFs did for a lot of the same reasons.
Yeah, absolutely. So, looking at it from the perspective of the investment side, now with regard to these things being originated and how it tracks with we cover liquidity, we covered kind of how you can average your like liquidity profile, if you will, by investing short term or late term, early term. Now, with regard to that, is there any inherent benefit to investing early term in something like this under this platform? Is there, kind of a first in, first paid structure, or is it just basically if there's still space in that particular bucket for that loan, how would that be repaid?
Everyone's pari passu. So everyone has the same standing when you're fractionalized in a loan. Whether you invest at the beginning of like on some of our new construction projects, we have a large new construction loan. We will, offer a piece of it, at the time construction begins, and we will offer a piece of it as construction is wrapping up, right? And some people look for those later, tranches of investment because they realize, hey, wait, some of the risk has been, already taken off the table because the house is almost done or it's complete. And now all we have to do is list it. And some people want that early part of the loan because their money's going to be working longer. And, some people aren't paying any attention to that, right? They just know that if it's a good project, they're going to get paid, and they're really looking at the duration, right, of how long their capital is going to be tied up. And I think the great thing about our platform at this stage is you can find all of it. Right? There is, all of that is available. And you can choose to spend the time to go look for it and allocate into it as you see fit, or you can let the software do it. Either way, you can win.
Now, with regard to the, kind of the end recipient of these things, I'm assuming, and just from what you're telling, kind of context clues, these are not going to be any type of owner-occupied properties, right? So you
Never.
kind of get rid of the headache of Dodd-Frank and all that kind of
Yeah, and I'll
stuff,
tell
right?
you the thing about this is that the other warning I have for people investing in rental properties is there's no free lunch, right? The money that's being put into these properties is being used to improve them, right? You are providing a venture loan to do value-added development work on a property that is aging housing stock, it's product development work, right? There's value added. That's why you can make money. And when we offer equity slices in these projects, as we're doing via our Groundfloor Labs sandbox to a small number of investors who are testing these products out, you're getting to stand in the shoes of the person who's actually running that project, the general partner on that project. And that's pretty cool, right? But the reason you're getting paid 24% IRR, on some of these construction projects is because you're adding value to the world. When you buy a slice of a rental home, you're not adding value to anything. And you're not being paid for anything except the hope and the prayer that house prices go up enough to reward you for the risk that you're taking, that you're going to make income along the way. You don't have that problem if you're invested in value added construction and renovation, which is why I think a lot of these projects pay, the rates that they pay.
And I assume that kind of plays into the broader issue of, just real estate inventory in the United States as well. We always, you hear about it on the news constantly, but there is, especially for people that operate in our areas, you really see just, how little inventory there is. And
Yeah.
especially with the population concentrations in the United States be what they are. Personally, I'm located in Pinellas County, Florida, which has been basically 100% developed for 70 years now.
Wow.
The 1950s was one of the last times that we had any type of, actual land development here. Some, they're going up, not, single family anymore. But, you hear about that and there's a reason for it is that the lack of inventory, what do? You can't create new stuff, so you have to improve stuff. And that's, again, kind of where this comes into play is the value add improvement for these types of loans going out there and creating value and driving the necessity to use a product like this on the borrower side of things, if you will, not to get too far off the beaten path of the investor centric stuff we're talking about, but again, you have to look at the consumption side of this as well, of what drives the need for something like this to be out there, not only to offer an investor an option, but offer someone that needs capital the access to it for this type of
Oh, and
product.
in this time, we're seeing demand for capital from more qualified borrowers on better projects on better terms than ever in our 10 years of operation. And the reason is obvious, right? Capital markets are constricted. And so you as a retail investor have a golden opportunity to step in and be the bank that the banks won't be and to be paid accordingly without taking much risk. At the end of the day, all risk is relative. And of course, there's risk in everything, right? But the risk is very controllable in this market, more controllable than I think it's ever been. And that's to me as an investor, that's an enticing opportunity. I love it.
No, absolutely. I think we're right on the same page with that. I really enjoy, how the market's evolved from, you've been doing this certainly longer than I have, but at least watching, people start to kind of come out of their shells from the Great Recession in 11 and 12 and then see, what's happened, where the pain points were and how it's evolved into what it is today has been really interesting to watch.
Oh yeah.
And one constant though, it's is really looking at, the velocity of money um, on the institutional side of things, your big banks doing the point of sale lending to people and just how, it was much more restrictive. It got a little bit less so, but, anytime that they is really any indication of monetary policy restriction or any type of, again, negative monetary policy from anyone's standpoint, it's not a small trickle on how that affects, the end user. It's like precipitous. It is it is the coyote driving off the cliff with the anvil coming on top of it. So being able to be able to be involved in a market that doesn't have, the whims of that to be beholden to, I think is really important. And, we see it
Well,
all the
and
time.
by the way, one of the interesting aspects of this that I've seen through the ups and downs of COVID and higher rates and fears over inflation and a half dozen other developments over 10 years in the economy. And people forget back in 2018 rates were going up as well. The Fed was raising and people were like,
Mhm.
"Oh shit, what's going to happen in the market?" What amazes me, and by the way, VCs and institutional investors don't understand this. They don't get it. It doesn't make sense to them. The retail investor is the most resilient source of capital. People are smarter and more capable than we think they are. They know what's up. There's wisdom in the crowd, and they've shown it. They show up and they're willing to put capital into things that, you know, people who have investment committees and limited partners and, career risk won't. And one thing
Sure.
I dearly love about the retail investor is their agency. They are their own decision maker. And when we have millions of people who are empowered to make their own decision without the impedance of needless intermediaries who are just taking fees for nothing, for locking up their capital, that's the kind of thing that I think financial technology can unlock. That's what we've been working on for 10 years. And I think people are starting to catch on. It's starting to become more evident in a way that this became more evident in public markets, with indexing. John Bogle preached indexing, from the 70s, and it took a while to catch on, with the investors, but it did catch on. And the same thing's going to happen in alternatives.
Yeah, and I really like the statement you made about, the agency of the individual investor. And also again to the point of, the larger institutions and VCs not realizing it. I mean, just take the segment of the world I live in. In retirement plans in the US, there's roughly 30 between like 34 and 38 trillion dollars worth of assets. That's a 38 with 12 zeros and four commas behind it. That's a lot of money out there.
It's
So,
unbelievable.
and that's just retirement plans. It's not including like what people have socked away in other places. So to discount the retail investor side of things, I feel like is shooting yourself in the foot is probably lightly. Maybe both feet or both kneecaps would be a better analogy for that. But
Well,
um,
we've been out talking to other originators of real estate credit and of real estate equity investment as well. And we're encouraging them to partner with us to access our retail investor base and help build more retail product. And a lot of them are afraid of the retail investor or don't or think it's too expensive or too slow. And we can show them, and we're starting to show, we announced a partnership program in our first two partners last month. We're starting to show how people who are doing amazing work in real estate finance can tap into that retail base. And I'm not trying to say that everything in real estate should be financed directly by retail investors, but I also think it shouldn't be zero,
mhm.
right? There's a
No,
non-zero proportion of retail investor capital that can and should be financing the future of what we build in many different categories, stuff we haven't even thought of yet. And I'm excited by that as an entrepreneur because I think this is a disruptive technology that's going to infect a lot of real estate over time to the benefit of the retail investor.
I think that's a very good sentiment to end this on. So, before my producer gets on here and she hooks us both off the side of the stage, I'll go ahead and bring it in for a landing. Brian, I really
Awesome.
appreciate your time today. It was an extremely engaging conversation. I have a lot of different guests on here, and sometimes I can relate more or less to some things they have going on. But being my entire career being based in alternative finance and specifically real estate, cutting my teeth with helping clients try to buy REO rolls off Bank of America, which is an exercise in futility I would recommend very few people engage in unless you really,
Hundreds.
yeah. I'm glad that they managed to get those roles cleared out, and then help my clients get some good deals. But again, I really do appreciate your time today. If people are interested in learning more about, fractionalized investing, specifically in real estate debt or what Groundfloor has going on, what's the best way that they can reach out and find more
Oh,
information?
just come visit us at groundfloor.com or reach out to me on Twitter. I'm just Brian underscore Daly. I guess X, I should say.
Or do what all the news agencies do, X, formerly, parentheses, formerly
Yes,
Twitter.
exactly. I'm just Brian underscore Daly there, and you can find us at groundfloor.com.
All right, fantastic. Well, Brian, thank you so much for being with us today. Again, as always, my name is Alex Perny. Thank you very much for being with us on this edition of the Alternative Investing Advantage podcast, and have a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.